So the primary mortgage market is where you guys actually meet together with the borrowers. You sit down with them, you take their application, you talk to them about the different types of loan programs, and you let them know what they need to expect when they're going through a mortgage. So mortgages are written instruments using real property to secure repayment of a debt. The process of highlight originating, highlight processing, highlight underwriting, closing, and funding. So you're highlighting all those, and I would circle originating because that's what you guys are going to be doing. And funding a mortgage loan occurs in the highlight primary mortgage market. This is where the borrowers, highlight borrowers, and MLOs come together to highlight, negotiate terms, and bring about a mortgage transaction. So your job is meeting with the clients and negotiating their transaction. The primary mortgage market is comprised of various lending institutions, for example, commercial banks, savings and loans, credit unions, mutual savings banks, mortgage bankers, and mortgage brokers. Commercial banks. So in the beginning, commercial banks, like I said earlier, they were more for like businesses, and they really didn't get into lending long-term money. Well, they didn't lend long-term money because a commercial bank was demand deposits. So if you look in the middle of the paragraph, you'll see demand deposits, highlight that, and then highlight money that consumers can, that a customer can withdraw from the bank at any time. So a savings and loan, the reason they were called savings and loan is, like I said earlier, people putting money in there to save because they were making money. So you had what would be called a CD, and a CD had a specific amount of time that you couldn't touch your money. So when I was a little itty bitty girl, I'd go into the bank after my birthday or after Christmas, and I'd put my money in, and I'd be like, okay, I'm not going to touch it for 6 months. That way, if I put that $100 in there, I'll have $100.06 in 6 months, or whatever I would have. So I was learning young how to save money. But commercial banks, they didn't have the CDs or the savings accounts. They were there for people that had commercial businesses. And so people needed to take their money in and take their money out, make money, do their payroll. So those are demand deposits. So because they were demand deposits, they didn't have money for long-term loans. So commercial banks originally were not in the mortgage business. But as the time kept going and they saw, oh my gosh, look how much money the savings and loans are making. Look how much money the people that are actually doing residential mortgages are making. So why don't we take our current customers and turn them into people that will use our other services, such as mortgages? So it says, if you come down under the large paragraph under commercial banks, in recent years, due primarily to the change in the law, commercial banks have increased their participation in home mortgages for several reasons. The first one, they wanted to take advantage of highlight existing customer relationships built through checking accounts and other traditional services. Banks anticipated that mortgage borrowers would come back as customers, highlight for other services. And important changes in state and federal banking regulations required banks to hold a percentage of funds on reserve for different types of loans based on the perceived risk of the loan. The least risky loan is when somebody puts 20% down and they're getting a conforming loan amount. So that's not risky to them because the person actually has skin in the game. They put in a down payment, okay? Over to the top of page 9, savings and loan associations. So remember, I talked a little bit about savings and loan associations, and they were all over the place. Like every city had a savings and loan on the corner somewhere. And I remember by Knott's Berry Farm, like on La Palma, and it's Knott's, I guess, Knott Avenue in La Palma, they had like 4 of them. And then Knott's took over one corner. I don't know what's in the other corners, but one was like one bank turned into a crystal and glass house. So they all ended up going away because of the way that they were doing their banking. So on top of page 9, savings and loan associations are also sometimes called thrifts. They're financial institutions which specialize in taking savings deposits and making mortgage loans. So like I said earlier, they take the savings, you have to hold it into your account for a while, you earn interest on it, while they take the money from the savings account and lend money to other people for their home loans, okay? When interest rates surged in the late 1970s, early 80s, the savings and loans were limited by law as to how much money in interest they could actually pay on the savings deposit. So basically what happened in the late 70s, early 80s was overnight interest rates went from like 8% to 18%. Yeah, I get the chills every time I say that because basically what happened was I was buying a condo. I was in the middle of buying a property and we already went to pick our flooring. Everything was going good. And the next day I get a call from the loan officer. I knew nothing about loans. And you guys need to understand that with your customers, Because you learn so much in these classes and you know so much about loans and how real estate actually works, you cannot expect your clients to know everything that you know. So I was a receptionist. I didn't know what was going on. And the guy's like, well, guess what? You can't buy your house anymore. And I'm like, wait, we picked the floor. We're ready to go. We've been waiting for this property. It was being built. It was brand new. And he's like, well, interest rates went from 8 to 18%. And you guys don't qualify anymore. So instead of qualifying for $85,000, you qualify for $58,000. I'm like, oh man, what am I gonna buy for $58,000? Well, I'll tell you, I bought a co-op. If you don't know what a co-op is, we'll be talking about those later. So when that happened, basically interest rates were so high, buyers wanted to buy, sellers wanted to sell, but nobody wanted to pay 18%. And the savings and loans, they were getting that money in from people and they were only paying like a low amount of interest out. But people who were smarter than the average person would be like, well, if I put my money in the savings and loan, I'm only gonna make like 5% of my money. But if 18% is the going rate, I'm gonna go invest it somewhere else. So that's called disintermediation. And if you look in the second paragraph, it said this resulted in widespread disintermediation, which is highlight the loss of those deposits to competing investments. So that didn't help the savings and loans one little bit. So the savings and loans started to see some problems coming around. Management mistakes, risky investments, economic slumps, and sometimes fraud resulted in a dramatic increase in the failure rate of savings and loans, which cost the federal government and taxpayers billions of dollars, leading to the massive restructuring of the industry. Savings and loans are required to keep 65% of their assets in mortgage-related activity or will be required to change their charter. So that's the Savings and Loan Association.